Good evening, Eric Mashinsky here on Tuesday, May 9th, 2017. I'm going to try to keep this audio video very brief tonight, maybe 10 minutes, possibly 15, but there are some important issues I wanted to go over. Basically the state of affairs in gold and the mining sector, which has been very weak recently. For premium members, just so you know, I will have something out for you later tonight or tomorrow on a couple of particular stocks that we don't follow in the free membership. So stay tuned for that. A couple of important updates on some core positions. First of all, to everyone, thanks for listening tonight. This should be worth your while. In fact, I know it will be worth your while if you are an opportunist. There are some things going on in the gold mining sector that are very unique. It's a one-time event that is already affecting the marketplace quite a bit. Some folks have been talking about it a little bit. It's gotten some coverage, but I don't think that people quite understand the gravity of the situation. It's really going to create tremendous opportunities in some names, and I'm going to give a couple of those that I think you'd want to keep your eye out for severe fire sale prices. What this revolves around is the GDXJ ETF. So I'm going to keep this simple, but talk about the basics. The ETF is a basket. It buys a basket of about the top 100 junior resource gold and silver companies. You can get a list by going to Van Eck and finding out exactly what their holdings are. It's all public information. But the GDX, which is the gold miners ETF, really focuses on the larger blue chip producer type securities. And GDXJ is designed to have additional exposure to exploration companies. There are some producers, but they need to have a market value that is lower in volatile my people buy an issue, which is successful. And inflows of capital and positions that they've already had, they are running into the issue of when you take a stake in the Canadian securities, you can go up to a 19.9% stake and still limit the amount of things that you've got to do as a shareholder, and you still have options in terms of being able to sell out of your position. And basically there's a tremendous amount of requirements that kick into gear when you become a 20% holder. So a lot of institutions or other, companies that take stakes in another entity will avoid going over 20% really at all costs. So unless you're going to buy the company out, you just want to remain below that number. And so what's happened is that GDXJ, with the inflows, they need to put that money to work, and they put that money to work in specific securities for broad exposure in the miners, in the juniors, and they're running up against that 19.9 number in a number of cases. And so what they've decided to do to alleviate that issue is they're rotating and rebalancing their portfolio in June. They're talking about June 17th to begin the process, but the process has already begun because they've made public the information of which stocks that they're going to increase and decrease their exposure in. So you've got funds, you've got short sellers, you've got individual investors. Everybody is essentially trying to front run that activity. Now, the problem for GDXJ and ultimately the opportunity for us is that this is kind of dumb to do this early, because what happens is, say you have, for example, and we've got I'm going to give you two examples of stocks that are being affected by this that we own. One is Sandstorm and one is McEwen Mining. They've come out and said that they are going to reduce their exposure in both of these companies, and I'm going to give you some details on that. And you'll notice that the performance in MUX and Sandstorm in this correction has been more severe than the rest of the sector in general. And you'll also notice that the correction in GDXJ has been much more severe than GDX. It always is more volatile than GDX, but GDXJ should not be almost testing its December lows when GDX is only testing its March lows. The bottom line is that people are dumping out of the securities that they know are going to be loosened up by GDXJ ahead of time, and then that in turn causes the performance of GDXJ to suffer. So it's a sort of self-perpetuating situation, and it's actually, I like it because this is going to create some imbalances in certain stocks temporarily that we can take advantage of. And let's just use McEwen Mining as an example. So what they're saying, and I'm going to pull this up, reductions, McEwen Mining. So it looks like they're going to be selling, bear with me, okay, 15 million shares of McEwen Mining. And because McEwen Mining trades about 3 million shares per day, the days that it will take them to unwind that, and this is assuming that it's the entire volume, the average daily volume in McEwen Mining, probably not wise to dump twice the average volume, meaning if it's trading 3 million now and you sell 3 million a day, you're doubling the volume, and obviously the stock price is going to suffer. But this is a way to look at, just like if you have a short interest out there, they call it days to cover. And that means that, you know, if there's a short position where it's a huge percentage of the public float and the daily volume, there's more potential there to get in trouble if you're on the short side. Say there's good news that comes out, you are going to run the stock price up a lot more because you just can't buy it. There's not a lot of volume. This is the same thing you want to look at here, which is the days to trade out of their position. McEwen's not that bad. That it's basically going to take them 5 days, or let me get this straight actually. So their days to trade are going to be 3. So that means that the average volume has actually been closer to 5 million. I got that backwards. So 3 days to sell out of it. You know, it's not a huge issue for McEwen, but what ends up happening is that a lot of the funds that mimic the performance of GDXJ and try to either beat it or just maintain it, they've got to react. And a lot of them are reacting now to get out in front of McEwen. So in this case, you know, you're looking at a big amount of stock that's going to be sold. There's other situations here that, I mean, I'm seeing some that are in the double digits, 10 days to trade out of their position, 20 days to trade out of their position. I mean, those are massive amounts of volume that are going to be coming out of these company stocks. And, you know, if you can time this correctly, because here's the bottom line. The bottom line is that this has nothing to do with the fundamentals of these companies. So if you have a disconnect, a disjointing of the valuation in some of these stocks temporarily because the index has to puke them out to get into bigger companies so that it doesn't brush up against that 19.9% interest, you want to be a buyer in that environment. You want to identify companies that are going to get hurt by this rotation and take advantage of the disconnect in the pricing. Let's see, for Sandstorm, let me pull this up. I've got it on my other computer. Okay. So Sandstorm is about 5 days. They've got 10 million shares, 10.5 million shares to dump, average volume of 2.2 million a day. So we're looking at 4.8 days to trade. Not insignificant. In fact, it is very, very significant. And we're seeing a lot of that selling once this was announced, kicked into gear. And that's why I think you're seeing on Sandstorm, on McEwen, on a couple of other plays that we've got exposure to in premium, you're seeing these stocks test their December lows. Whereas if you look at the GDXJ as an index, they're only testing the March lows. So some of these stocks are getting hit way worse right now than the rest of the sector because of this GDXJ issue. Now, you could say to yourself, well, and I know there's some people that are promoting that this is going to be the buy opportunity of a lifetime. It could be. But if you get into June and say that these stocks are going to start getting slammed on the 17th, do you want to hold off on buying any of them until then? Perhaps, but that doesn't mean that they're going to be just puking down to new lows at that time. For example, what if we go to war with North Korea on June 15th or June 7th and gold skyrockets and the miners perform very, very well? That just means that the selling that GDXJ would do would be absorbed much easier, and it would be done at higher prices. But if you have weakness in the sector, which we do have now, and which, in the summer, June's usually not terrible, but there's a lot of lethargy in the sector. So some of these situations could really get hit, which I'm looking forward to. Imagine if you get a pounding on MUX where this thing trades down to $2 USD. You have got to be prepared. If you want to be successful, in general in this sector, you've got to be able to take contrary action. I say it all the time. It's Buffett's rule: be greedy when others are fearful, be fearful when others are greedy. How many of you are able to do that? It's not as easy as it sounds. It's simple, but people get clouded with all kinds of crap. And another thing is, short term, I talk about the short term moves in the market. We do trade, but you've got to be willing to be patient to make a lot of money in this space. And this situation in GDXJ is going to create, and it already has. I mean, we're already seeing a situation with GDXJ. And here's the beautiful thing. So within a year, Van Eck, and I'm sure it's going to be within a year, they say 1 to 2 years, they're going to create another GDXJ, which is going to be more along the lines of how this GDXJ started. And what's going to end up happening is the GDXJ that we see today is going to turn into more of a mid-tier ETF. You're going to have GDX with the big cap producers, GDXJ with the mid-tier, sort of mid-cap plays. And then you're going to have a new vehicle, let's call it GDXJJ, which is going to come out sometime between now and call it, next summer. I think it'll come out sooner because there's too much money flowing into this stuff. People want exposure to the juniors, but the GDXJ as we know it today is not going to give you the real juice that if you want these junior miners. This is going to speak to guys like me, actually, the need for people like me that are going to do research on individual names that are going to outperform. Because if you want true exposure in the juniors, you're not going to get it through GDXJ anymore. It's going to be up the rung. It'll still do well in a bull market, obviously, but it's not going to do as well as a Southern Silver or a Timberline. Because those deals are true juniors. They're very, very small, and they're just more volatile. So they go down more on the downside and they go up more on the upside. So in any event, there is going to be another one in the hopper. And so what are they going to do at that time? We don't know when that is, but they're going to buy back the MUX. They're going to buy back the Sandstorm. And so these stocks are going to get a boost from the ETFs again in the future. And in the short term, they're giving us, they're going to leave us with some really discounted shares to scoop up. If you really want to take advantage of this, one thing that I'm going to be doing is really zoning in on the exact times to go deep and hard into not only McEwen and Sandstorm, but a couple of other opportunities that I love that are on the reduction list. And we're going to monitor this in premium. And so if you want to try to take advantage of this, I don't know if it's going to be one of these like once in a lifetime deals. It could, but it certainly is it's creating an opportunity to get into the juniors at really good prices before gold goes, above 1,400, which I still think is going to happen in calendar 2017. So just moving on very quickly, Patriot Gold, PGOL, finally got their Canadian approval. They should start trading tomorrow under symbol PGOL on the CSE. You can find the quote, thecse.com will have it. So if it's not tomorrow, I think it'll be tomorrow. So keep your eye out. If you are a Canadian investor and you've been waiting for Patriot to be listed there, the good news is it's here. That should help our liquidity in the US as well. Uranium. So with uranium, I want to say that, this sector's gotten whacked. We've had URA, which is the ETF, has really been smacked below its support levels. And so I'm not going to get into a ton of it tonight, but I just have to say that we're going to have to be patient with uranium. I think the jury's out if we're going to have to deal with some more downside back to the trend line, back to the lows. If we're going to retest the bear market lows, I don't think we'll go to new lows, but it certainly is possible that this was a sort of the big burst out of a basing bottoming process. Same thing with the gold miners. We saw the burst in the first half of last year, and now they are forming a bottom. This stuff takes time, and the bottom formation is in, and we're seeing higher lows and higher highs in a lot of cases, but it's a process. And so the same thing's going to happen with uranium, and it's going to create some really good opportunities, which I think it already is, in some of our favorite juniors like Appia, API in Canada, APAAF in the US, Encore Uranium, EU and Canada, TGRUF in the US, and then also sort of the step up in liquidity and size, or URRE, Uranium Resources, and Mega Uranium, MGA, MGAFF in Canada. Those are my 4 top holdings in the uranium sector. I've basically said that we're holding on uranium. One thing I am doing though, I'm holding URRE, which is, if you recall, because of a very successful trade that we had early on, my cost average is really low. It was basically free, and then I bought back a little too early on buying that position back. So I think my literal cost average is like 20 cents. And we're trading at about $1.50, $1.60. So, I hold it essentially in my mind for nothing. So, it's free. So essentially I'm just going to hold there. And, with Mega, we're back to 17, 18 cents on MGA. If you recall, this is where I initially started recommending the stock. So, my cost on MGA, I'm back to break even. If you bought it higher, you probably want to consider adding to those positions soon, and do it slowly and do it modestly until we get some more clarity on when things are going to rebound in the uranium sector. But long-term, very bullish. When these things took off and I first approached to take a stake in Encore Energy late last fall, there was not even a pulse on uranium, but I started to say to myself, it's time to start chipping away. And, it may take years, but we're going to make a lot of money on the uranium bull cycle. So it came quicker than I thought, but, now we're getting, maybe it was getting ahead of itself a little bit. And now we have to wait and see if it's going to take a longer basing period and a bottom formation, or if we recover quickly here. In any event, I'm very bullish long-term on uranium. That's the case. And, look, if you bought some of this stuff for trades, then use your stop losses and sell them. If you don't want to wait, dump them. If you're a long-term investor, you have to buy on the pullbacks and add to the ones we like. You have to realize that these situations that are going on, when people email me and say, what about such and such a company? There's no reason for them to go up or to go down other than the sector is going up or down, unless you hear me announce something or you see that there's news that has come out in the companies that caused the reaction, or a big overreaction, say on the downside or upside. If it's material news, we'll address it. If it's not, it's the status quo. The sectors trade together, more or less, and so we just have to deal with the fluctuations and position ourselves accordingly. One thing that we have seen in terms of company-specific news that's very, very bullish is Gungir, which has received their $1 million royalty. This is GUG in Canada, 8-cent stock, and ASWRF in the US, which is at about 6 cents. This one, if you recall, the premium members, I made this pick initially at a half a penny. So we're up 16 times our money on GUG from the initial position. And then I think we came out to the free members at a penny or at a penny and a half. So we're up, 5, 6, 7 times our money on GUG and the free members. But this thing is a strong buy under a dime. There's so much blue sky in this thing. It's crazy now that they're getting $1 million a year in a royalty payment, and they've got these properties in Sweden, which could just be huge. Orion Resources and Barcelli have rocketed into the 100 million plus market cap level, and Gungir is trading at a $5 million market cap with potentially the most prospective projects in the entire area around Sweden and Finland. Now they've got money to drill. So this summer, I'm really excited to see what they find in the initial drilling program in Sweden. I'm going to have more on this stock in detail soon, because my gut has always told me that this one's going to be one of the biggest winners that I've ever had. And it's on track for that. I mean, we financed it at 3 cents, got a 5-cent warrant. I started buying it at a half a penny. This is like 100-bagger type of stuff with Gungir. Really looks good. So buy that one on weakness. Very special situation. There's your update on Gungir because it has had something material and company specific. Lastly, lithium looking really good. If you notice with LIT on the ETF, LIX, which is Lithium X, LAC.TO, Lithium Americas, these are the leaders. They have been stealthily breaking out. So we've got a couple of lithium plays that I think are going to outperform. I'll have more on that later this week. But I think lithium's about to bust out here. You may want to have some exposure in the sector. I've held off on being a lithium bug, so to speak, a lot. As most of you know, I've traded the sector, but we've not really taken any big long-term positions. I think that's about to change, and it has changed. We've started to take positions in some low-price stocks in the lithium space. Keep an eye on LIT, LIX, and LAC to see what the temperature in the space looks like. But they're breaking out, and it could be really good times ahead for the lithium stocks. And it could be some really opportunistic times for the Gold Investment Letter subscribers that are willing to jump in and take some risks between now and the end of June with this GDXJ rotation, with some weakness in the sector. I'm strongly bullish on gold and silver long term. That has not changed one iota. If we get a dip in the gold stocks down to retest the December lows, no problem. If they break down below the December lows, it's gonna be an issue in terms of how low do we go on a correction. But if we do not break the December lows, particularly on GDX, because that ETF is in place, HUI you can look at as well to determine the health of the gold miners. Then it's, you need to buy near those support levels. Retesting lows is a normal situation in a bull market before they go higher, and that's what we've continued to see with the gold miners since they started to take off early last year. So you can use that as a level of comfort with stop losses just below the December lows, so that if they do break down and you're heavily positioned, you can lighten up, limit any losses on big positions. Know that that's the case. We're not going to ride it down to retest its 2015 lows if that were to be the next stop. But until then, I actually don't think we're going to see that. I don't think we're going to see $1,000 gold. I don't think we're going to see the retest of the 2000 and late 15, 2000, early 16 lows in the gold miners. I think the December lows are probably all we're looking at. And so until we're proven wrong, you want to be a buyer in a bad market like right now. Buy your favorite names, particularly keep an eye on Sandstorm and McEwen Mining to be buyers on weakness, because they're getting hit. They're getting oversold for no reason other than rotations of an index, which will end up coming back to put wind at the back of these companies in the future, and we can take advantage of it. Thanks very much.